Hey, welcome back everyone. And we are back into the course. This is the lesson number 7, which is about the intermediate term concepts, our intermediate level ICT concepts. We previously went over the beginners of ICT concepts, and this one is going to be really important because we're going to tap into some concepts that you're going to use repeatedly over and over again. And thank you so much to FT UK for sponsoring this video and this entire course basically, and making it accessible to everyone. They are one of the best firm in the industry, operating for 4 years. Make sure to check them out. Link is in the description. So we are going to be discussing order flow first, and order flow is basically the trend or direction of the market. So whichever way the market is moving, we are going to say that way is their order flow. If market is going to the upside, we're going to say the order flow is bullish and vice versa. Now, there are a few ways to identify how what order flow currently it is. So for bullish order flow, the bullish PD areas will be respected and it will give support to price. The bearish PD areas on the left side will be violated and price will take out short-term lows and expand higher. Now, if you don't know what short-term lows are, don't worry, I'm going to explain it later in this lesson. Then price is going to expand higher and retrace lower. So what this means is that when price moves up, that move will be explosive. But when it comes lower for the retracement, that move is going to be small. Then for the bearish order flow, it's completely opposite. Bearish PTRS are going to be respected and they're going to provide resistance to the price. And the bullish PTRS are going to be violated. And price is going to take short-term highs and expand lower. And price is going to expand lower and retrace higher. Now take a look at this schematic here. This shows a bullish order flow and this shows a bearish order flow. This is bullish order flow because price is moving up. It moves up, expands higher, retraces small, then expands higher, retraces small, takes a short-term low, and then expands higher again. And in all this, it respects the PD areas. There are going to be fair value gaps here. There are going to be fair value gaps here. There's going to be an order block here. It's respecting that and going higher, and completely opposite on the other side if you look into it. Now, this is another one of the most important thing to understand is that when in we go to low time frame, okay, let's say this chart here, this is our 4-hour chart. We are going to assume that. Now, when we go to 15-minute chart and we look into that same order flow, so let's say on the 4-hour chart, the order flow was bullish. But if we go to the low time frame on the M15 chart, the order flow might look something like this. Okay, so this is the low time frame retracement in bullish order flow. So what I basically mean is that this is the 4-hour chart bullish order flow, right? But if you go zoom into this area here or this area here or this area here, you're going to find price action like this on the low time frame. Now, this is where most of the people get confused, and what they do is that they will assume that price is now moving lower. They would ignore this bullish order flow on the 4-hour chart and they will look into this and say, oh, the market is going lower. I think we are supposed to sell here. But it's just a short-term retracement. And after this, price just explosively moves higher. And I'm going to show this in an example. Take a look at this. So we can clearly see price is moving higher, right? It is in an uptrend. It is taking out short-term lows, moving higher, respecting PD areas, moving higher. But there are these short-term retracements. So if I now zoom into this area here, look at this. Now, would you sell here? I mean, yeah, if your strategy is trading retracement, then you can of course sell here, buy back here. But can you just assume the whole direction of the trend from this chart? Absolutely no, because the overall chart is in expansion. It is, in bullish order flow, it's expanding to the upside. So we are not gonna think that market is now gonna move lower, and we would treat this as a retracement. And this alone is gonna make your trading way more better if you just understand the difference between a retracement and an expansion. I have another example here as well. It is moving to the downside on the higher time frame. Now I'm going to zoom into this area here and this retracement here and look into this. It is moving to the upside. But does that mean that the trend has shifted? Absolutely no. This is just a retracement. And if you look into this low time frame chart, this looks like a bullish order flow, right? So in higher time frame bearish order flow, the retracements are going to look like lower time frame bullish order flow, but you have to identify the difference between that, and that's going to make your trading way more better. And here's another example as well. Price is moving to the upside, but in the retracements, price is moving to the downside, right? It is in a bearish order flow on the lower time frame. Then the next is generated liquidity. This is also important. And it is basically when the algo generates liquidity. They actually generate this in order to like make people put stop losses on a certain level and then to take them all out. So there are basically two types of liquidity generations. One is consolidations are equal highs and equal lows, and then low resistance liquidity runs. You might be familiar with this, but you may not be familiar with this one. So let's get into it. So here's consolidation. This is how consolidation looks like. Price is just contracted in an area in a price range, and then this is low resistance liquidity run. So what low resistance liquidity run means is that, let's say price has created a low like this, that moves higher, come backs down, but doesn't take out the previous low. So it is an LR. Again, it comes lower but doesn't take out this low, so it's an LR. And same here as well. But if you look into this here, it created a high, moved lower, and then took out this high. So this is an HRLR. So that's like the main difference between an HRLR and an LRLR. And here are different examples of it. We have consolidation here, price moves up, take this out, then moves higher. We have another consolidation here, and then takes that out. And if you look into all this is also LRLRs here, and price takes them out. Another example here, there's consolidation here, price takes that out. And then here's an example of LRLRs. A lot of LRLRs are generated, and price moves up and take this out. And you'll see consolidations and LRLRs in retracement phases. This is where you are going to most likely see these generated liquidity, because in retracements, market just wants people to believe that it's going the other direction, but it's just not. And later it is going to take that area. Here's that same example, but here I have shown the LRLRs, and take a look at this, how neatly it takes that out. The next important concept that we have is internal range and external range liquidity. So if we talk about internal range liquidity, it's basically an FVG, and an external range liquidity is any high or low. And this is the ERL IRL cycle, or IRL ERL cycle. Price goes from IRL to ERL and ERL to IRL. So take a look at this. This is how an IRL to ERL cycle looks like. So we have an ERL. As I said, ERL is just any high or low, and IRL is just any fair value gap. So price is at IRL, and we have ERL to the upside and ERL to the downside. And look what happens here. Price goes to the ERL. So this is our IRL to ERL cycle. And how are we going to anticipate that price is going to go to the upside and not the downside? It's by looking at order flow. So if the order flow is bullish, we are going to expect price to move into a bullish IRL and then go into an ERL to the upside. And here's how an ERL to IRL cycle looks like. So when price moves higher, let's say it's trending to the upside and it takes out a high or an ERL, it's now going to retrace. And where's that retracement going to be? It will be to an IRL. And that's what happens here. So if you look into this, actually, this can be your trading model. If price takes out ERL, you can go to a low time frame and confirm if price is going to the IRL and sell there or buy there in case of if the order flow is the other way. And let's say if the price is at IRL and you know that market is bullish, you can just look for buys there if price shows some signatures on the lower time frame. So this alone can also give you a model. And if you specifically look into ERL to IRL, it's biasless. You don't need a bias here. Just wait for price to take out ERL and then wait for it to move to IRL. That's it. You don't have to understand if the market is going higher or lower. And here are the different examples of it. Price takes out ERL, IRL, and then ERL again. Again, ERL is taken out, IRL, and then ERL again. ERL is taken out, price moves to IRL. And then again, an ERL is taken out, price moves to IRL. And again, ERL to IRL cycle here. And then ERL to IRL cycle again. And you can actually check all these examples in the PDF file that will be provided. Link will be in the description. You can always study them in detail and look into it in much more comprehensive way. And then same thing here again. Now, the next thing that we are going to cover in this video is going to be market structure. And market structure is also important because it will help you determine the order flow or trend. It will help you understand where to put your profit level or stop loss level. And it is also going to help you confirm your bias. We have three kinds of highs and lows: short-term highs and short-term lows, and intermediate-term highs and lows, and then long-term highs and lows. We have two main categories in this. One is protected highs, and then the other is unprotected highs. Protected highs mean those highs which are not going to be taken out in a trend, and unprotected highs are those which can be taken out in a trend and price can still continue towards the direction. So if we talk about protected highs, it is basically intermediate-term highs and long-term highs, and unprotected highs or lows are short-term highs and short-term lows. I've written a note here. Long-term highs and intermediate-term highs and lows are basically HRLR, while short-term highs and lows are LRLR. So HRLRs aren't taken out in a trend, and LRLRs are easily taken out by the market in a trend. So let's look into it in more detail. So this is a long-term high. A long-term high is basically going to be the point where the market reverses from. Long-term low here, long-term high here, and a short-term high and a short-term low is basically going to be any high or low that's in the trend. So this is a short-term low, 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 this is a short-term high, this one, And then we have intermediate term highs and lows. Now, what is an intermediate term high? An intermediate term high is a kind of high which has a short term high below it to the left side and a short term high below it to the right side. So if you look into this short term high, you can see it is below it. And if you look into this short term high as well, it is below it as well. So in the middle, we have an intermediate term high. And remember, an intermediate term high is most likely not going to be taken out by the market. So this means that you can put your stop loss here. You can, let's say, sell here and put your stop loss here and expect price to move lower. Same thing here as well. And in case of buying, you can put your ITL, your stop loss at the ITL, and then expect market to move higher without taking this out. And this is one of my trading models that I'll get into in the later videos. And here are the examples of it: a long-term low, short-term low, intermediate-term low, then short-term low again. And you can look into all these examples. They will be given in the PDF file. You check that out in the description. And you can look into it. If you have any question, you can ask me in the Telegram, which is given below. It's also free. And yeah, we have all these different examples here. So thank you so much for watching this video. And if you want to practice in a broker, make sure to check out BingX. Link will be in the description. You will be given up to $10,000 in bonuses. And if you want to trade with a prop firm, make sure to check out FT UK. They are one of the trusted firm in the industry. Link will be given below in the description as well. Thank you so much and see you in the next one.